Welcome to this edition of the Investors Wisdom Nuggets. Today I want to talk about an area where I've received so many questions from prospective university students and their parents or guardians. This is also a very ripe area for examinations, especially when you are taking the ARCA Financial Management module, the first part. The examiners would always want you to demonstrate that you understand the critical differences between accounting and finance. Generally speaking, the accountant is more interested, or his role is to record transactions. That is more of a micro role. Transactions are recorded each and every day. Although at the end of the accounting period, which could possibly be a quarter, a half year, which will be interim financial statements or year-end financial statements, they will then have to collate and prepare a set of financial statements which usually are for publication, that is for consumption of the general public, and usually their information is prepared in such a way that it should suit the requirements of a wide spectrum in terms of users of accounting information. When it comes to finance, finance generally has three core functions, the pillars of finance. The first critical role of the finance manager, if I would put it that way, is to identify investment opportunities. What do we mean? Identifying projects where a business can actually invest their money and earn a return which is above the investor's expected or required rate of return. This is the first function. Secondly, after identifying those opportunities, it is also the duty and role of the finance manager to come up with a decision on how these projects should be funded. When we talk of funding, this is the financing decision. Now the finance manager is deciding, should we use debt, should we use equity, if we use both, in what proportions. This now is determined by the risk appetite of the investors and the risk profiling of the individual projects identified. You will realize even one company may actually fund its portfolio of projects differently in terms of the capital mix. Related to this task of making the funding decision, there is also this aspect of deciding on the working capital management. Working capital management, we are now talking about liquidity, how much cash to keep. Where you have requirements of a working capital nature, you have to decide as well how much of this requirement is a permanent requirement, which may actually require to be funded by permanent capital, and how much is fluctuating requirement, which requirement would then need to be funded by capital short-term financing. The third and last pillar is the decision on how to distribute what could possibly have been earned from the investment. The dividend decision, the dividend policy. It is the role of the finance manager to decide what dividend model, what dividend policy to pursue. Usually, you find the finance manager will always want to match their dividend policy to what is generally expected by the investors. Why? Because dividends have an information content. When you declare a dividend, it communicates something to the outside world. If you are an expert in finance, you would understand if you declare a dividend, you are generally surrendering resources to owners. You are saying, at this point, we have not managed to identify any meaningful project or a project where should we invest, we would actually earn a return which matches or surpasses the current return being earned on the current portfolio of investments that we have. That's the first aspect. The second aspect, if you are also clever, if you see finance people issuing shares, deciding to issue shares as a methodology of raising capital, behind their minds, behind the background, what they are actually telling you is they believe the market is overvaluing their company's shares, and There is no need for them to utilize debt. There is no need for them to utilize retained earnings. They would rather go and get cheap financing. So they are saying the market is not correctly pricing the riskiness of their business. So these are, in general terms, the difference between the core functions of accounting and finance. However, these two are complementary roles. Finance people and accounting people work together to achieve one purpose: creating value for stakeholders, creating value especially for the shareholders. Thank you so much for listening. If you had liked what I'm talking about, kindly like my channel, share this channel with colleagues. If you have any other burning issues that you think I can address to your satisfaction, do not hesitate to put them forward. Thank you so much for your time.